Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. Last week delivered a compelling blend of optimism and caution in the markets. U.S. equities surged, with the S&P 500 rallying about 1.23%, the NASDAQ climbing nearly 1.12%, and the Dow Jones Industrial Average advanced around 2.25%. All of this was driven by dovish commentary from the Federal Reserve, clearing tariff policy, and solid earnings results across multiple sectors. Now, simultaneously, the bond markets offered a more nuanced picture. The 10-year Treasury yields rose about 10 basis points, ending at 4.28%, and the 2-year yields edged up to 3.76%, as softer labor data and tariff-driven price pressures fueled speculation about future rate cuts. Now, overall, the week showcased a broad-based equity rally, especially in tech and consumer sectors, which was counterbalanced by modest upward pressures on yields in fixed income. So let's talk about this in more detail, starting with our key market indicators this week, as well as we'll continue our discussion by reviewing the contributors and detractors of the market. Now, we'll do this all while looking at both equity and bond markets to provide a more comprehensive view of market movements and the impact to your portfolios. So with that, let's hop right in. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 2.5% growth as of August 15th, which is the same as what we reported last week. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims data showed that initial claims fell by 2,000 claims, ending at 224,000 for the week, while continuing claims also fell to 1.953 million. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw further downward movement in mortgage rates, as everyone can take a sigh of relief. Both in the 30-year and 15-year mortgage rates fell, ending at 6.58% and 5.71% respectively. Next, we'll look at investor sentiment. One measurement of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread fell from a negative 8.4% last week to a negative 16.27% this week. Investors are continuing to feel more bearish with the current market. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship to the S&P 500. Remember, the VIX values above 30 are typically linked to large volatility, resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 15.09. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 92.1% probability of a 0.25% decrease and only a 7.9% probability of no decrease in September. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 1.23%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was positive 3.2%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was positive 2.78%. And the winner this week goes to aggressive stocks for the win. Now, remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. Now, if you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. So with that, let's jump right into our discussion around the contributors and detractors in the market movement in the past week. After a positive week, we had a number of contributors that drove both the equity and bond markets. On the upside, we saw there was a lot of rate cut optimism on the equities. Specifically, we saw investor sentiment, which was buoyed by growing confidence in a September Fed rate cut. Now, this was driven by mixed signals, where the consumer price index, which was released last week, showed that inflation was cooling. Core CPI, which excludes volatile food and energy prices, rose much more than anticipated. We also saw the producer price index released last week. Now, this was surprised to be much higher than expected, indicating persistent inflation pressures for producers. Next week, we'll watch very, very closely to how the PCE data, or personal consumption expenditures data, comes out, because this gives us better visibility as to how consumers are actually feeling inflation. And another quick note, that it's the preferred inflation gauge of the Fed. We also saw last week that there was great market rotation. What I mean by that is there was a broader equity breadth that was noted, and the rotation was more into small and the mid-cap space, specifically healthcare and media sectors, which, healthcare and media sectors, which are beyond the usual tech heavyweights. Small cap equities outperformed significantly, signaling improving risk appetite and belief in easing monetary policy. We also saw sector highlights. As I mentioned, healthcare and communication services led the gains, with healthcare up by 4.6%, communications up by 3%. Health services, health tech, and communications stood out, while utilities, producer manufacturing, and industrial services lagged. On the tariffs and trade side, markets seemed to absorb much of the tariff headlines much more smoothly this past week. Some relief came from the U.S.-China tariff deadline extensions, which were extended for another 90 days. Now, on the bonds and fixed income side, Treasury yields rose last week after technical rebounds and weak auction demand, while credit markets remained buoyant and municipals drew strong investor interest. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.